Glass shatters, voices yell, flashbulbs flash. The Treasury Secretary storms out of a closed-door press briefing. His tie is loose, papers clutched tightly, his face red. Scott Bessent isn't walking, he's charging. Cameras catch just 5 words. We sent the letters. 100. And with that, Washington falls silent. Bessent revealed that 100 countries have received what he calls tariff letters. But critics quickly pushed back, saying these weren't letters at all. They were ultimatums. No talks, no negotiations, no diplomacy, just a heavy-handed warning. Agree to new trade deals under U.S. terms, or get hit with tariffs not seen since the 1930s. According to Bessent, these new tariffs would bounce rates back to April levels, with some reaching as high as 50%. But here's where the first problem appears. Most of these countries never agreed to any talks to begin with. Yes, countries like Vietnam, South Korea, and Mexico still depend heavily on exporting to the U.S. But the majority of recipients have stayed silent. No replies, no outreach, no official statements. The silence speaks volumes. It suggests either they don't think Trump will actually follow through, or, more likely, they've already moved on. That silence is not weakness, it's strategy. Bloomberg's global trade trackers report that over 63 of the 100 countries on Bessent's list now do more trade with China or India than they do with the U.S. That's not about politics, it's basic math. So why would they agree to unequal bilateral deals with Washington when they're already connected to lower tariff trade routes through BRICS? This isn't rebellion, it's simply indifference. And the timing couldn't be more dangerous. Trump has delayed triggering the tariffs again. First, the deadline was July 7th, then it moved to August 1st. Now Bessent says it's not a deadline at all, but a signal. Markets, however, aren't buying it. The S&P 500 instantly dropped 2.1% intraday the moment Bessent's comments hit the Bloomberg terminal. But investors aren't reacting just to the tariffs. They're reacting to the chaos. That chaos includes a $3.4 trillion tax expansion passed just weeks earlier, sparking fears of debt-fueled inflation baked directly into U.S. policy. There's no clear line, just repeated warnings and trade partners who refuse to pick up the phone. And now, there's a second front opening: BRICS. Trump's latest order imposes a 10% automatic penalty tariff on any nation seen as aligning with so-called anti-American BRICS policies. But here's the catch. The phrase anti-American isn't actually defined. Is it de-dollarization, joint infrastructure deals, multilateral payment systems? If you take that logic literally, even Germany, a U.S. NATO ally, could be punished for settling trade with China in renminbi. Brazil could face double tariffs for participating in a BRICS reserve asset program, even though that program, to settle commodity trades like oil and lithium using a shared currency, hasn't even launched yet. This isn't drawing a line in the sand, it's moving the target, and the target is anyone who tries to trade outside the US dollar. There's also a deeper irony. The global trade system the US is now trying to punish was built by the US itself. The WTO, the IMF, SWIFT, and even bilateral trade agreements, all shaped, funded, and enforced by Washington for decades. But now that BRICS is creating a new financial system, one built around non-dollar trades and raw commodities, that same US-built system is being turned back on itself. The interdependence the US once promoted is now becoming its own weakness. Let's think about the raw numbers for a second. In 2000, the G7 controlled 70% of global GDP. Today, that's fallen to just under 43%. Meanwhile, BRICS has risen from 18% to 34%, and the number is still climbing. China alone is projected to make up 19% of global GDP by 2029, according to the IMF. If BRICS formally expands to include Indonesia, Egypt, and Saudi Arabia by 2026, the bloc could control 46% of global productive capacity and more than half of the world's critical minerals output. So, the real question is, what power does a tariff letter really have in this kind of world? Washington still insists that its large consumer market gives it unmatched leverage. But leverage is a two-way street. According to U.S. Census Bureau data, America depends on $3.1 trillion in foreign imports every year. China, despite all the tensions and tariffs, is still the #1 supplier of U.S. electronics, batteries, pharmaceuticals, and auto parts. Sure, Bessent's tariffs might squeeze foreign exporters, but let's not forget, American producers will suffer too. They'll face higher input costs, broken logistics chains, and retaliation from trade partners. And that retaliation isn't just a threat anymore, it's already underway. In 2024 alone, China's BRICS trade reached 4.6 trillion yuan, or about 650 billion US dollars, marking a 5.2% increase from last year, according to China's Ministry of Commerce. And this happened despite recession fears in Europe, rising interest rates in the US, and a global slowdown in demand. Now think about the impact if penalty tariffs push trade realignment even further. With a single executive order, Trump could pressure US allies to redirect supply chains toward BRICS countries. And once that shift happens, it's unlikely to reverse. It's not speculation. It's already happening. Reuters reports that since 2023, more than 37 countries have set up official RMB settlement channels. The Gulf Cooperation Council just approved UN-based oil contracts, while Brazil and Argentina now conduct over 40% of their trade with China without using US dollars. This isn't just a theory, it's a rollout. The consequence? A gradual but steady decline in global dollar demand, which leads directly to less appetite for US treasuries. Let's look at the numbers. Bloomberg reports foreign purchases of US treasuries fell by $289 billion over the past year. Who's selling? Primarily BRICS nations and their closest partners. China alone reduced its holdings by $12 billion, marking its fastest reduction since 2016. Why? Because less trade in dollars means fewer dollars need to be recycled into US bonds. That leads to lower treasury demand, higher US borrowing costs, and the start of what you could call the Besson's boomerang. The damage comes back home. But China isn't just pulling out of treasuries, it's stockpiling gold. The People's Bank of China added 70,000 troy ounces in June alone, bringing its 8-month total to over 34.2 metric tons, based on official records. This move isn't about getting returns. It's about avoiding U.S. political risks like sanctions, debt ceiling fights, or sudden policy shifts. Gold is safe from all that, and that's exactly why BRICS nations find it so appealing. Here's the irony. A metal the U.S. once removed from its monetary system is now a tool Beijing uses strategically. Even Europe is starting to pivot. In a surprising move, a German church pension fund invested $50 million into a Hong Kong-based China equity fund, according to the Financial Times. Why? For exposure to high-growth, undervalued Chinese tech and industrial sectors. But beyond the profits, the symbolism is huge. This is a NATO-aligned institution putting money into a market Washington labels as adversarial. So while Bessen-Kraft's tariff deadlines loom, BRICS is quietly attracting Western capital. And yes, the markets are responding. Year-to-date, the Hang Seng Index is up 21.3%, compared to the S&P 500's 6.7%. This doesn't mean Wall Street is collapsing, but it does show capital is diversifying. Investors are starting to price in long-term risks tied to U.S. fiscal and trade policies. When market volatility feels permanent, investors look for systems, not just quick returns. Stability becomes the new currency. That's why China's next move is even more provocative. According to Bloomberg, Beijing is considering expanding the southbound bond connect, which would allow up to 1 trillion yuan, around 140 billion US dollars, to flow into foreign debt markets. At first glance, this might seem helpful to the dollar, but in reality, it's about replacing Wall Street's role. The goal? According to People's Bank of China sources, it's to build a financial system in Hong Kong that allows both inbound investment and outbound access. But that system only works if investors no longer need Wall Street. And with Hong Kong's stock exchange preparing to list more sovereign BRICS bonds, a new financial ecosystem is emerging, one that can grow without U.S. support and potentially against it. Meanwhile, Trump's fiscal plans could make this worse. His latest tax bill added $3.4 trillion to the U.S. deficit, based on Congressional Budget Office estimates. Inflation expectations for 2026 jumped by 1.7 percentage points after the announcement. But the most dangerous part might be political, not economic. According to the Joint Committee on Taxation, the top 20% of earners gain 2.3% in annual income under the new law, while the bottom 20% lose 2.3%. So, while tariffs drive prices up, the purchasing power of the lower and middle classes shrinks, right as the wealthy move more assets offshore. What happens when the middle class can't consume? Growth stalls, retail slows down, small business investments freeze. This isn't just a theory, it's a modern replay of the 1970s, only with different actors. The Peterson Institute estimates that if August tariffs kick in, inflation could spike by 15 to 20%. For most households, that kind of pressure is unsustainable. At the same time, BRICS nations are expanding credit, lowering rates, and subsidizing trade. The contrast is stark. The US tightens, while BRICS accommodates. And here's the final twist. This shift may have been engineered using the very system the US built during globalization. Think about it. The US exported the trade corridors, digital payment rails, alternative currencies, and infrastructure models that BRICS now uses to unseat American dominance. It's not a coup, it's a remix. If the US keeps threatening rather than competing, it won't be tariffs that isolate America, it'll be gravity. So what do you think? Will BRICS back down? Will Trump adjust his strategy? Or are we witnessing the final breakup of the old global trade order? Let us know in the comments. And if you're enjoying this video, please like and subscribe.